For many Americans, financial stability feels solid right up until an unexpected medical emergency changes everything. A sudden illness, accident, surgery, or long-term health issue can create bills so large that even people with jobs, insurance, and savings find themselves struggling financially. The frightening part is that medical debt often builds quickly and quietly, affecting credit, savings, retirement plans, and long-term financial security in ways many people never expect until they experience it personally. Today we will talk about most Americans are one medical bill away from bankruptcy. Are you? So before we get started, make sure to hit that like button, also subscribe to my channel. 10. Most people assume health insurance fully protects them. For many Americans, having health insurance creates a sense of security. The assumption is simple. If something serious happens, insurance will cover the costs and prevent financial disaster. But the reality is far more complicated. Medical bills remain one of the leading causes of financial stress in the United States. Because insurance often does not eliminate costs, it simply changes how those costs are structured. Deductibles, co-pays, out-of-network charges, prescription costs, emergency fees, and uncovered treatments can still leave families facing enormous financial pressure even while technically insured. Many people do not realize how financially exposed they are until a medical emergency suddenly forces them to confront the system directly. 9. Healthcare costs have increased faster than wages for years. One of the biggest reasons medical debt became such a major issue is the long-term rise in healthcare costs. Hospital care, surgeries, medications, insurance premiums, specialist visits, and emergency treatments have all become dramatically more expensive over time. Meanwhile, wage growth for many households failed to keep pace with these rising costs. This creates a dangerous financial imbalance where a single unexpected medical event can consume savings that took years to build. Even middle-class families with stable jobs often struggle to absorb major healthcare expenses without taking on debt. 8. Insurance does not always mean financial protection. Many people believe insurance automatically prevents catastrophic financial outcomes, but modern healthcare systems often involve significant out-of-pocket expenses. High-deductible plans require patients to pay large amounts before insurance coverage fully begins. Certain procedures may not be covered completely, and network restrictions can create unexpected bills even during emergencies. In some situations, patients receive treatment first and only discover the financial consequences afterward. This uncertainty makes healthcare one of the few major expenses people may face without fully understanding the final cost beforehand. 7. Medical emergencies often trigger broader financial problems. A serious health issue rarely affects only medical expenses. Illness or injury can also reduce income if someone cannot work consistently during recovery. This creates a double financial impact, rising expenses combined with reduced earnings at the exact same time. Mortgage payments, rent, utilities, transportation, childcare, and existing debt obligations continue even while income becomes unstable. Many families can survive either higher expenses or temporary income loss individually, but handling both simultaneously becomes financially overwhelming very quickly. 6. Debt becomes the default survival tool. Because few households maintain enough liquid savings to cover major medical emergencies comfortably, debt often becomes the immediate solution. Credit cards, payment plans, personal loans, and borrowing from retirement accounts are commonly used to manage unexpected healthcare costs. While these tools may provide short-term relief, they can create long-term financial damage through interest, reduced savings, and ongoing repayment obligations. A single medical event can therefore continue affecting financial stability for years after the health issue itself has passed. 5. The problem extends beyond low-income households. One of the most surprising realities about medical debt is that it affects people across multiple income levels. Financial stress from healthcare is not limited only to poor households. Middle-class families, professionals, and even relatively high earners can face major financial disruption from serious illnesses, accidents, or long-term treatments. Rising healthcare costs combined with inflation and existing living expenses leave many households financially vulnerable despite appearing stable on the surface. 4. Preventive care is often delayed because of cost. Another hidden problem within the healthcare system is that financial fear itself changes behavior. Many people delay doctor visits, medications, screenings, or preventive care because they worry about costs. Unfortunately, delaying treatment can sometimes lead to more serious and expensive medical problems later. This creates a dangerous cycle where financial pressure discourages early healthcare intervention, potentially increasing both health risks and future expenses simultaneously. 3. Medical costs are difficult to predict or compare. Unlike many consumer purchases, healthcare pricing often lacks transparency. Patients may not know the cost of procedures, tests, medications, or emergency care beforehand. Prices can vary dramatically between providers, hospitals, and insurance networks. This makes financial planning around healthcare unusually difficult compared to other major expenses. People can budget for housing or transportation more predictably, but serious medical costs often arrive unexpectedly and without clear pricing structures. 2. Financial vulnerability is more common than most people realize. Many households appear financially stable externally, while operating with very limited emergency reserves internally. Rising housing costs, debt payments, childcare expenses, insurance premiums, and inflation leave little room for unexpected crises. As a result, a single major medical event can quickly overwhelm finances even for people who seem responsible and hardworking. The problem is not always reckless spending. It is often the reality that modern living costs leave many families with extremely thin financial margins. 1. Medical emergencies and financial emergencies became deeply connected. The deeper truth about medical debt in America is not simply that healthcare is expensive. It is that health crises and financial crises increasingly happen together for millions of families. Because the truth is simple. When healthcare costs rise faster than wages, savings remain limited, insurance leaves major gaps, and unexpected illness disrupts income, even financially responsible households can face overwhelming pressure. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.